Okay. So bad debt provision for bad debt and bad debt recovered. Like the provision for depreciation, there is also another highly examinable, area you don't want to joke with, because it has provision in there. It has some similarities with the provision for depreciation and how you go about it, right? But the difference is that provision for depreciation is related to fixed tangible assets, while this one is related to our current assets, specifically debtors. Okay, so this bad debt provision for bad debt and bad debt recovered is bordering about debtors. Now, who are debtors? These are the customers who owe the business. So customers who owe the business, these are the debtors, right? So why this discussion about them? It so happens that when your customers owe you, a lot of things can happen. When I say a lot of things, things like death. Death is inevitable, so anybody can die at any time. There could also be the possibility of insanity, right? The person goes mad or loses his mental capacities. So my question to you is, would you be able to, as it were, or as a business, chase somebody who is dead to come and pay how much he or she owes you?
Yeah.
Profella, you chase the person. Did you want to say something?
No.
If you chase the person,
The family members.
the family members. But there are people in this world who have no family members. If it's possible, some people are just so well. We don't want to
The
go
money
there.
for his funeral, they should give it to him.
When they do his funeral, they should get you will take the entire body to defray the debt. Well, so we are discussing in the context of a business, right? So businesses may not be chasing for some debt because of certain happenings like this. If the person dies and the person did not even leave anything behind, or his or her funeral was one that, imagine, the person even just got missing. You didn't hear from the person, but they didn't do any funeral because there was nobody to do any funeral for. So it can happen like that. So there will be no funeral for you to go and take the entire body to defray the debt, right? So we are saying that every business, because of some of these happenings, you have to think about making provisions, right, for them. Sometimes it becomes necessary for you to even cancel the debt, because if the person is dead, you have to cancel how much the person owes you because it becomes irrecoverable or irredeemable, right? So let's look at the bad debt. And I think the things I've just spoken about gives us a clue. But bad debt is an amount owed by a customer of a business, but cannot be settled by the customer. Or it is an amount owed by customers that is deemed irrecoverable. Okay. It is deemed irrecoverable due to certain reasons, like one, insolvency. When we say insolvency, it means that a business or a customer or a debtor whose assets cannot even settle his present liabilities, right? In other words, when you sell all the assets, it cannot pay how much the person owes. The person will still be in debt. So that person is insolvent. Okay. In other words, his or her debts are more than his assets or properties. So sometimes it becomes possible for a business to consider a debt irrecoverable if the debtor is insolvent. Okay. And I think some of you appreciate that in real life. If somebody owes you and wangasa wo assess nipa no se no akwa we de or nibi, you feel sympathetic and, cancel the debt or push it into the irredeemable, debt. The second one is insanity, or the person goes mad, right? I'm yet to see a business chasing a mad person to claim their debt. I've not seen some before.
Wait for my.
Ella, what are you saying? Well, the third reason is death of the debtor, an unfortunate event, but it's going to happen. So if your debtor dies, I'm not sure you can go to his grave. It would even be so cruel of you that at the funeral, you'll be saying, I'm coming for my money, given how sympathetic we are. The fourth one is debt. The debt is immaterial. Okay. I don't know if any of you here will be chasing a colleague for a debt of 1 pesewa. Nobody will be chasing somebody for 1 pesewa, especially where the cost of collecting that 1 pesewa will be more than even the debt itself. Imagine you are in Accra and a friend in Cape Coast owes you, say, 5 Ghana cedis. Okay, mommy, I'll come to you, okay? And then you take a vehicle all the way from Accra to Cape Coast just to come and collect 5 cedis. Oh my God. So when the debt is immaterial or insignificant, we tend to ignore it or write it off as a bad debt. Okay, mommy, you have the floor.
Please, I just wanted to go to the previous slide for like 1 second.
Oh, okay. You want the note, right? Don't worry. I'll put down the note, but you can take few notes. Yeah, very important. You can take few notes here. So things you want to note down is bad debts is an amount owed by customers that is deemed irrecoverable or irredeemable. As for the English, you can always manipulate them. And some of the reasons for bad debts are as follows. So insolvency, insanity, death of a partner, or if the debt is immaterial. That being said, I think I owe somebody some notes on, I think if yeah, we'll talk about it on the personal page. Okay, so Mami, I want to believe you have taken a few notes, but I'll share it in the group for you to have access to the notes. Now, having known what bad debt is, as accountant, we have to know the debit and credit you have to do when a bad debt occurs, right? Because that is why we are into this profession. So when a bad debt occurs, this is the double entry you do. You debit a bad debt account, and then you credit the debtor's account. So immediately you get a hint that, oh, this customer is dead. This customer has gone mad. This customer is insolvent. This debt is immaterial. The entries you have to do is to open a bad debt account, debit it, and you credit the debtor's account. And to make it more meaningful, why are we crediting the debtor's account? We are crediting the debtor's account because we want to cancel the debt. And debtors have a debit balance. So if you want to cancel it, because the rationale behind the bad debt is you getting to write it off your books or canceling it. So if you want to cancel a debt, then you have to credit the debtor who has a debit balance. So as you credit, it cancels it. And then you debit your bad debt account. Now, one thing you have to note is that bad debt is an expense. So at the end of the year, you have to write it off into your profit and loss account as expense. So the writing off is the reverse of what you did earlier. You debited it in the first place. So if you are canceling or moving it to the profit and loss account, you credit it. So that is why you see at the end of the year, write it off or transfer it to the profit and loss account by debiting profit and loss account and crediting the bad debt account. Let me demonstrate that on our screens so that we can appreciate it better. I think I have some demonstration here. Let me get that so that we can follow it very well. Okay. Okay, so let me make it larger for the whole screen. Okay, so this is an example as to how this would figure out or fizzle out. Please don't go and check the dictionary for some of these words. Okay, so let's look at it. Kwame is our debtor in our books. So Kwame is a debtor here. So we are assuming that Kwame owes us 50,000 from a sale we made to Kwame. So as you see here, when you make a credit sale to a debtor, you credit your sales, you debit the person. So as it stands in our books now, Kwame is owing us 50,000. If it so happens that maybe due to certain reasons we feel Kwame cannot pay the debt, right? So we want to write it off as a bad debt, or the debt has become irredeemable. Then I'm saying that you are going to credit Kwame, who is the debtor, and you debit your bad debt account. Okay. So let's say that because of the insanity, right, Kwame cannot pay 10,000 of the debt. Because sometimes it's possible that even though the person is mad or dead, you can sell some of his properties off, or you can get some in nsawabodie from the funeral, as some of you were suggesting. But maybe it will not be enough to clear all the debt. So let's assume that in the case of Kwame, the bad debt is 10,000. Then we say you would credit Kwame with a bad debt of 10,000, and you debit the bad debt account. So that will be Kwame 10,000. So this is what you do. That's the first point we made, that if bad debt occurs, you debit bad debt and you credit the debtor. So the essence of that is it is canceling the debt, right? But at the end of the year, you have to transfer this bad debt account into the profit and loss account. So in doing so, you credit bad debt account with your profit and loss, or P&L, 10,000. And then you debit your profit and loss account, or as part of your expenses, bad debt, 10,000. So that is what I meant. Any question on that? Any question? Okay, if we are clear on that, then let me make the final point on this bad debt. So every year when bad debt occurs, you debit it. At the end of the year, make sure you transfer it to profit and loss account, right? So in the bad debt account, realistically, you are not supposed to be carrying forward or carrying down any bad debt. So in a typical bad debt account, you will not see balance carried down, balance brought down, because every year we close it and transfer it to profit and loss account. So note that, because in our exercises and illustrations, they'll come up. Okay, so having dealt with the bad debt, let's go to provision for bad debt. Provision for bad debt. And please, this concept, I'm sure when you were doing the trading profit and loss account, it came up and some of you were confused, right? So please use this opportunity to ask me any questions or clear your confusions. Provision for bad debt, or provision for doubtful debt, right? This is the rationale behind it. So let's go back to the Kwame scenario. Kwame is our customer who owes us, right? And due to some reasons, we heard of Kwame's, unfortunate car accident. So as a business, there is this concept called prudence concept. And I believe my students who were with me last, I think Form 1, you remember this concept, prudence concept, or also known as conservatism. You can note it down. It is part of the principles that govern how accountants should go about their work in terms of reporting on the financials of a business. The prudence concept says that as an accountant, you always have to make provision for future possible losses. Okay, that is the bit I want to bring to bear. But the full concept says that the accountant is not expected to be anticipating profit or predicting profit. If you're an accountant, you don't have to be predicting profit. Even if there is evidence that it is going to happen, you don't have to predict or anticipate. But you should always be on the watch or the lookout for possible future losses and make provisions for them. Okay, so the provision you are seeing in accounting is because of this or this concept. Now, on this background, it becomes necessary for businesses to be doing analysis of their, operations and determine any possible loss, future loss. So if people are owing you as a business, you should be prudent enough to know that there's a possibility that some of them will not pay because they may die or they may go mad or anything can happen to them. So because of that mindset, businesses are supposed to make provisions on their debt, hence provision for doubtful debt or bad debt. So immediately a debt becomes doubtful. For example, your friend owes you 100 Ghana cedis and you just heard that she has traveled to Canada and on her way she got some cocaine and she's now mentally not sound. I think you have to begin to think, say, hey, and the music 100 Ghana and I show, right? So that's the thinking. You should begin to think that there's a possible future loss. Or you hear that somebody who is owing you is in the hospital emergency unit, unfortunately, right? You begin to think, the mind will prick and tell you that, Charlie, and you can ask. Okay, so that is the way of thinking of businesses regarding their debtors. So provision for bad debt is an estimated amount charged against profit to cater for debts which may go bad or deemed irrecoverable. So the business tries to set against its profit, to be able to cater for any future possibility of some debtors not being able to pay their debt. Please, can I move on? If you have a question, please ask me. Now, if I want this to sound a bit reasonable, let's do it this way. When you come to school, you know that in the future, you are going to incur transportation costs back home at the end of the semester. So every prudent student will begin to make provision for his or her transport back home. That's the essence of some of these provision. You look into the future and determine a possible expense or loss, and then you make provision. So as you are giving your chop money, and here your chop money is the profit of the business, you begin to, squeeze some of your chop money against that transportation. So that's, if I should say, the similarity or a scenario which is likened to provision for bad debt. You set aside your profit to cater for a future possible expense or loss. Again, let's look at the double entries you have to do as an accountant, right? So as an accountant, if you are making a provision, you see, it comes in three folds. And please, dear student, listen to me and listen carefully. The first one, or the first fold, is when you are creating it. So the creation of the provision for bad debt. Or let me say the initial. Let me qualify it. The initial. Initial here means the first time you are making that provision. Now, after that, you can have another fold. And the second fold is that sometimes it becomes necessary for you to increase the provision for the bad debt. And as well, sometimes it becomes necessary for you to decrease the provision. So let me explain this using the transportation bit. So you see that when you come to Form 1, okay, at the end of the first semester, that will be your first ever transportation back home. So that will be the first or the initial creation of provision for transport you make, right? Now, it becomes possible that due to circumstances, you have to increase the provision. So for instance, in the first semester, you took out of your pocket money, say 20 cedis. Hey, David, Cape Coast to Accra, those in Wesley Girls, Cape Coast to Accra, how much are you charged? I think in excess of 100 cedis. Let me do 100 cedis. Okay, so you make provision for 100 cedis the first time. The second semester, when you came back now, because of the fuel price increment and stuff, now it is 150. So that means that you have to increase your provision from 100 to 150. It can also happen that, because of, better economic conditions, now transportation fares have been reduced, even though that is not the case in our country. But there's the possibility that transport fares may be decreased. And so now the lorry fare is, or the transportation is, say, 80 cedis, right? So it means you have to decrease your provision to that 80 cedis. So I'm just alerting you on the fact that you can have an increase and a decrease. So as accountant, we have to know the debit and credit you have to do in the first time you create it. If you have to increase it, what double entries do you have to pass? And if you have to decrease it, what double entry do you have to pass? Fortunately for us, the first and the second folds have the same double entry, right? So the increment and the initial creation have the same double entry. And what is that? You debit your profit and loss account and you credit your provision for bad debt account. Why are we debiting profit and loss? We are debiting profit and loss because, remember, we want to pick some of the profits, and profits have credit balances. So if you want to set aside profit, you have to debit it. Okay? So we debit profit and loss account to remove the credit, and we put it in the provision for bad debt account. So again, picture it like this. Provision for transportation account. And then your profit is your chop money. So if you want to make provision for transport, you have to remove it from your chop money, right? Your chop money has a credit balance. So to remove it, you have to debit it. And that's why we are debiting the profit and loss account. And the credit will go into our provision for bad debt account, or in your case, provision for transportation account. If you have to increase it, it is the same thing. You do the debit in the profit and loss, and you do the credit in the provision for bad debt account, but with only the increment, or the increase. The reverse for these two is the decrease. For the decrease, so let's look at the transportation. Let's say you provided for 100 cedis for your transport, and it so happens that when you go to the station, the driver says pay 80. Okay, so you made provision for 100. Now they are saying pay 80. So it means you have to decrease your provision from 100 to 80. So that decrease of 20, what will happen to it? It will come back to your chop money. So it will come back to add on to your chop money. And if your chop money is profit and profit has a credit balance, if you are adding to it, you credit. So we credit the profit and loss account and we debit the provision for bad debt account with the decrease. So I'll pause for any questions before we move on. Please ask me question if you want me to take certain points all over again. Okay, I'm sure you won't ask me questions, so let me use the opportunity to summarize. So I'm saying that, dear professors, for provision for bad debt, it comes in three folds. The first time you create it, that's the initial creation, you debit your profit and loss account. Then you credit the provision for bad debt account. Right? If you are increasing it, you do same. You debit profit and loss and you credit provision for bad debt account. But you do that with only the increment. Okay, you do that with only the increment or with the increase. However, if you have to decrease your provision, then you have to reverse these two entries by debiting your provision for bad debt account. And then you credit your profit and loss account. So these are the things I want you to remember because you need them when you are preparing the provision for bad debt account. Any question before I move on to the bad debt recovered concepts? Bad debt recovered concept. Okay, if there are no questions for me, I think this time let me use the rest of the minutes in this session to ask questions. So what is bad debt? Define bad debt. Bad debt. Yes, who's going to do that for me? Prof. Joel, have you been here for long? Can you define bad debt for us?
Yes, please, I joined not too long. I had some issues. So
Okay.
I didn't join it.
Okay, thank you, Prof. Please make use of the video if I share. Mami, Prof, yeah.
So please, bad debt is the amount owned by a customer of a business which cannot be settled by the customer.
Okay. Or which is deemed irrecoverable or uncollectible. You can add the reasons to make your definitions or the definition sharper or better. Due to death, insanity, etc. Okay. So what is the double entry for the occurrence of bad debt? When bad debt occurs, who do you debit and who do you credit? Prof. Kenton, can you do that? When bad debt occurs, who do we debit and who do we credit? Okay. Prof. Bennett, can you assist the masculine voice man? I'm sure he's clearing his throat. Prof. Bennett. Okay, so debit bad debt and credit the debtor. Exactly. Thank you, Prof. Bennett, for that. Okay, but I indicated to you that at the end of the year, you have to write it off to profit and loss account, right? Now, you have to remember this double entry because the question will require you to prepare the bad debt account. So please, don't ever forget these double entries. So you debit bad debt, you credit the debtor when it occurs. At the end of the year, you write it off to profit and loss by debiting profit and loss account, crediting the bad debt account. Okay, now for the provision for bad debt, we have seen three scenarios. That's the initial creation, the increase, and then the decrease. And for each of them, you have to know the double entries you have to pass. The clue here is that the increment and the first or initial creation have the same double entry. That is, you debit your profit and loss, you credit provision for bad debt. But if it's a decrease, you debit provision for bad debt, you credit the profit and loss account with the decrease. Okay, so let's join the final session and move on with the bad debt recovered. And I'll talk a bit about the debtors account and how to prepare that. Then maybe we can zoom into solving illustrations, God willing, tomorrow. I'm praying that we can clear this topic as early as possible. Okay, so let's meet in the next section. Awesome, professors.